Hi, this is Randy Finney with the right side of the chart, and this is a closing market wrap for Monday, October 17th, 2022. Won't be a very long one. I'm not going to spend more than just a minute here on the equity markets. Today was a day of nothing, pretty much technically, that is. Remember, I was hoping or expecting last week that we might have some resolution this week as to where the market's going to go. And this week is still young. Today is day one. Remember, earnings are really ramping up here, earnings season that is. And within the next few weeks here, or next couple weeks, we'll have the big market moving fangs. But right now, mostly financials reporting last week and this week. And today was a day of nothing. Nothing meaning this is that level, the key level that was our previous bear market low, a major reaction low in mid-June right there. We came in and tested it recently. The buyers stepped in, they got sold into, then we broke down. So that was a breakdown of support. And now we've had 1, 2, 3 days. This is the third consecutive trading session, that is. We had last Thursday, Friday, and today. And so far, today, can't call it a rejection. Remember, we did get rejected on Friday. So on Thursday, we back tested, closed right on the level, essentially. Again, that line's right at the lows, 268.28. We closed at 268.48. Remember, 20 cents on a 200, almost 300 point security is nil. It's basis points, meaning a fraction of percent. So that's, for all intents and purposes, we continue to backtest. We backtested there, tried to regain it, got rejected pretty impulsively last week, but remember, we never took out the bottom of the candle. We just didn't get confirmation to the upside. And then today we closed right on that level, pretty much traded under it all day. Give you those levels this morning on QQQ to watch. This was it here with the purple lines. And so you can see pretty much that first resistance level, which is essentially the previous lows, is what capped the advance today. So, as again, incrementally, if we go up, and of course that 271, we'll call 271.90, that would be a takeout of the previous highs. That big candle from Friday, remember, I'm sorry, last Thursday, the bullish engulfing candle, and that will start to give check marks for the bulls, and anything above that. There's still a mountain of resistance overhead, but again, if you look at it, taken in conjunction with everything else, in other words, the fact that we broke the lows, if we regain it, solidly regain those, take out the downtrend line, and that's also going to confirm the divergences that run all the way from the 60-minute charts to the daily and up to the weekly charts, and that in itself gives us a bullish setup. So all you need then, that's technical. If you throw in some type of fundamental catalyst like a Fed pivot or anything of that nature, then that would certainly, again, the charts are priced in. We could get that rally. Otherwise, if bulls fail to take it out here, then remember, support is support, or resistance is resistance until unless broken. So this is just a repeat of Friday's analysis that basically we broke support, we're back testing, and we'll see where we go the rest of the week. And just remember, whipsaws, you have a much higher rate of whipsaws during earnings season because of these companies reporting and all the knee-jerk reactions and all that other good stuff. So, again, good time to keep it light. All right, let's look at a couple other things here. When I clicked on NQ, it took me to the 10-minute chart. This is my active trading chart. It's not what I intended to cover in the video, but since I'm here, I might as well. You get all these, if you look at all these lines I have drawn, these are divergence lines, and these catch the micro trends, I call them. Again, 10-minute chart means 10-minute candlesticks. The day breaks are down here, October 11th, 12th, 13th, 14th, 17th, 18th, so forth, so on. This was right here, divergent low. You got a little rally. Then we had the big hot inflation number. Remember that was Thursday's knee-jerk reaction. Put a divergent high right here. That was our first divergence. Got a little correction. The divergence extended even bigger. Got a bigger correction, and then we had this into the weekend here, little divergent low last night on Sunday night, and that broke out. That positive, aka bullish divergence right there has been the catalyst for this rally. No divergence now, so this might indicate a little upside here before we get the next reversal. I'd have to clean it up, but the next decent resistance is up here about 11,354. Also keep in mind, sometimes when you have events that occur, such as a recovery of these levels, everything I just talked on the daily time frame, a breakout there, especially when there's a lot of pent-up energy. For example, when the Qs have been back testing that level now for 3 trading sessions, that could lead to a pretty powerful spike that could override any divergences or anything on the little short-term 10-minute charts. These are good in a fairly trending market, up or down. Let me go to the 60-minute chart for you and show you there. So this is the downtrend line right here on QQQ. You have our minor downtrend line there. Plenty of reactions so far to validate it. 1, 2, 3, almost 4 now. That's resistance. Pop that, and then there's a larger downtrend line that comes in up here. And a pretty decent, probably, yeah, they both come in together about 11.785, and the intersecting larger downtrend line. And should we hit that, the odds are decent, especially with the right fundamental news. And again, resistance is resistance until unless broken. We could just as easy get rejected, and then there's a little minor downtrend line to watch. But that'd be about a 6% pop, if so, to get up to that next trend line. Okay, let me show you something else. Like I said, today's update it's not a whole lot to report on the markets because we're just still testing that resistance level here for the last 3 days, 3 sessions to be exact. Commodities, remember, this is what's been driving the stock market to almost the fullest extent. This is probably, it is, yeah, without a doubt, one of the most important charts to watch, probably as important as the stock market itself, and that is DJP. For a while now, it's been my go-to commodity proxy, and inflation proxy as well, because it's a broad-based commodity index. And lately we've been drifting lower. So this is really, the Fed was dismissive of this huge run up in commodity prices until it was too late. They were behind the curve. But traders are going to be watching this. I know I'm not the only one. You would have to expect a lot of eyes are realizing now, well, what's going to determine when the Fed backs off or slows down on their rate hikes? Obviously, it's going to be an abatement in inflationary forces. The Fed, for whatever reason, likes to use lagging indicators and things that are behind. So this is more of a real-time indicator, and one of the most important. Real estate, unfortunately, isn't priced day by day, minute by minute, and so that takes a longer time to show through. But we can look at crude oil and natural gas, both of which have been falling lately, and you can see here we're zigzagging our way down. So I still have this target down here at about $31. It's yet to be hit. And it looks like we're probably going to head that way. The PPO is down below the 0 line. It means the trend's bearish. We're about to get a bearish PPO crossover. And if not, if you see this and a breakout above 37, that's going to be bullish for commodities, bullish for inflation, and bearish for the stock market, because it'll continue to keep the Fed's hands tied. The more this drops, the more wiggle room the Fed has to do that pivot that everybody's waiting for. All right, so that's that. Keep an eye on it, and on that too. Probably want to know USO. Remember, I give you this whole thing here. I've had forever and a day this long-term swing target of 58.60 plus the primary uptrend line. We had a false breakout here, as I pointed out last week. That breakout failed with a move back down below the downtrend line, and so that opens the door for a move down there. Now that's going to be net bullish for the equity markets. This is why I have concerns over the last couple of weeks. Why I've shifted from what I thought was a clearly bearish, the risk reward clearly to the downside, favoring to the downside. And now, like I said, doing a video last week with various breadth indicators starting to improve, not all, and some sentiment indicators high. Again, I'll just keep saying the same things over and over in case anyone's new. I do not believe the bottom of the bear market's in. It's just a matter of, we're going to get a decent bear market rally here or not, or is this just a little pause on the way down? And so these are the things we'll watch. This, obviously would be net bullish for the stock market. That doesn't guarantee the stock market goes up. It just provides a potential tailwind should stocks want to rally, a fundamental catalyst, and that would be the crude oil prices continuing lower. UNG, we swung UNG. The last swing or trend trade was all the way down here from the top to this target. This was my final swing target from the downside. So we just like this rip here, a good part of it, we caught that, and just like a lot of the ups. But we consolidated. Remember, I told you for a little while I didn't really do many updates because we hit my target, and then we just kind of consolidated around it, which was a combination of the 2271 price support plus the primary uptrend line. Well, you can see what happened. When you get a range like this, a consolidation range, in any security, whether it's a stock market, a commodity, and then you have a definitive breakout to one side or the other, that's usually going to determine the next major trend. So you consolidated. Bulls had every chance to ramp it up here, didn't do it. This is a pretty powerful breakdown today. This is down 6.8%. UNG, the natural gas ETN. I don't have much of an opinion on it. I don't have really a position. I could just say that's net bearish, but I'm looking at the PPO poised to make a bullish crossover. I see big support down here, about 1958, and I'm just sharing what I'm seeing. So if it continues down, that helps the inflation case, or the case that inflation may be abating. But if it bounces back up, makes a back test, then that's not good. So again, I don't have a dog in this race right now, or a horse in the race, whatever that saying is there. But there's the 60-minute chart, some positive divergence. That's why I wouldn't be. I have no position. So if I had to do anything, I can't make a case. I don't take pot shot trades. This is in no man's land, what I call, when it's between support and resistance, and divergence is not a buy signal. So I just wanted to update it more so to just keep an eye on and watch that trend. The more it falls, the more you're going to probably see the stock market rally, with the expectations that the Fed can either hike less, or maybe even come out, and that's a pivot. You don't have to go to a rate cut. Nobody's expecting a rate cut anytime soon, but just some type of a pivot there. Let me show you one other thing I wanted to talk about here before we get, and I'll wrap up with gold, but let me show you the bonds. So today was a very unusual day. And I maintain what I said earlier. I still like Treasury bonds. I'm still waiting for the buy signals. They're just something to scale into, and I'm also using them as a hedge against swing short positions, trend short positions. But what I'm looking at here is still a breakout of that downtrend line on TLT, and more so the yields, TYX, the 30-year Treasury yield, TNX, the 10-year Treasury yield. I covered all those earlier. So we still need to see that. But yet yields were up again today. And look at that, made ever so slightly a new high. And today, that was unusual, very unusual. So what I have here, let me do TLT. Okay, what you're looking at on this chart are you have TLT, and that's the 30-year Treasury bond ETF. So there's 30-year Treasuries in white. LQD, these are investment grade corporate bonds, and then JNK below investment, aka junk bonds, corporate bonds. So those have a investment grade rating. Treasury bonds, of course, have investment grade, and so anything below the triple B rating is considered junk, double B or lower. And so they've been moving in almost lockstep, and that's in itself pretty unusual, but that's because Treasury bonds and the stock market have been moving in lockstep. See, why it's unusual is junk bonds, they are a bond, they're a fixed income, that's an asset class. However, they don't behave like other bonds. Normally, they trade more so in line with the stock market and economic fundamentals because they pay such a high yield. The dividend, or high yield, yes, correct on that. The rates, the funds pay dividend. If you buy the bond itself, it's called interest. And so what happens is the biggest thing to watch on junk bonds is the default rate. And so when the economy tends to, well, it's a straight function. When the economy slows down, especially during recessions, the default rates spike. So therefore, and when the economy is strong, you have very little default. So therefore, junk bonds tend to trade more so in line with the stock market than interest rates. But this year, everything's flipped around. The Fed has just mucked everything up, and the old rules and the old correlations just don't even apply anymore. We're in a rising rate environment, inflationary environment, so everything's been going down. But my point is, you can see the almost perfectly correlation. Don't pay attention to the difference in where the lines are. Just when one's going up, is the other going up, and when one's going down, are the others going down, and that has been the case in lockstep all year. And you can let me get rid of that little pop-up. You can do this yourself and look at these, do a comparison, and there are very few. Here's one little disconnect there. You went down. What was that? Junk bonds going down, and corporates and Treasury investment grade going up. Today was a big day. I don't know what it means. It's a trend to watch. Almost always you get a mean reversion. So in other words, the junk bonds were going down, but then quickly they went back and played a game of catch up and got back to where the others were. So one of two things is going to happen, and I think it's going to be a mean reversion. Now, mean reversion could mean Treasuries go up soon, even if this happens for another day or a few more days, or the others go down. So something to watch. And when you also add on the S&P 500, you'll see that as well, that the S&P 500, like I said, has been trading almost in lockstep as well with bonds. And today was an unusual day to see TLT down 0.5% and everything else, especially those other bonds, moving up. Now, I mentioned before, and I meant to get to those in a video, so I'm going to show it now because I forgot to last week. I told you I wanted to cover those. So you can see it's almost what I call the everything setup now, and that's because everything's been moving in tandem this year. Like I just said, stocks, bonds, all bonds, treasuries, as well as junk bonds and corporate bonds. So everything across the board, stock market and bond market related, including these LQD, the investment grade corporates, they all have the same or very similar setups. There's a bullish falling wedge, positive divergence. Let's see if we roll back here. Let's go to a weekly chart. Yeah, that's pretty much it. We're at long-term support down there. But see, even on the weekly, you have the positive divergence as well. And again, a very well-defined trend line. And this would probably break out and run if the stock market does. So like I said, there's a lot of setups here. A breakout of this, if corporate bonds rally, it means that the market's implying that financial conditions are going to stabilize. And so that would probably coincide with some type of pivot, whether it's explicit or implicit by the Fed. And again, a setup to watch. But like the stock market, we're just hanging on to those divergences by a thread. We're right off, just day or two off bear market lows, and so this could certainly go the other way. Like I like to say, resistance is resistance until unless broken. So if it breaks out, you can take it on face value. There's your first resistance, but if it fails, and it fails with a solid move back down below the trend line, and especially a move down below those recent lows, then that's going to be bearish. So that's LQD. JNK as well. Oops, I typed it wrong. JNK, junk bonds, same setup, bullish falling wedge, nice clean down trend line. First resistance here, move that up a little, about 90. And again, a lot of things setting up like that. MUB or your municipal bonds, and they just recently broke out of their downtrend line and back tested after putting in a divergent low as well. So like I said, a lot of charts are showing these divergences. This is that point. It's kind of the ball's in the bull's courts. They've got the perfect setups. And so far, we've just been batting around back and forth the last few days, and not just the stock market, but these as well. But again, it makes sense because bonds have been highly correlated with the stock market. So those are your setups, and that's why this thing can and will, I think, soon break either way. I don't think we're going to consolidate for weeks or months. Anything is possible. So the takeaway is stay flexible. And like I said, though, and pay attention to that the differential between Treasury bonds and the other bonds I just mentioned, because that is unusual, and one way or another we're going to get probably a mean reversion here soon. And because of the setup in Treasuries, that's what I threw out to you recently. ZN, you've got just these beautiful downtrend lines. And so, if they break out, I imagine the corporate bonds will as well. You could certainly trade that. Like I said, I've started to shift money, 401k funds that have been in cash for a while, into Treasuries and bond funds as well, general bond funds at old corporates, because I think the risk reward is more favorable than the stock market. And just so you understand what that means, look, if we rally and everything breaks out, stock market's probably going to go up more. But if all of a sudden we take another leg down, the stock market's likely to fall more or even crash. And probably not going to see that much more downside in Treasury bonds would be my best guess, based on the technicals and for fundamental reasons as well. The Fed would have to come in. The central banks would have to come in if we saw a crash in Treasury bonds. The U.S. would go broke. We can't afford to service our debt and just break everything internationally. Other countries hold a lot of our debt and settle trades and deficits in U.S. dollars and payments and all that. So it's just, like I said, unsustainable, the rate of ascent that we've had. And so I have very, very high confidence that the treasuries were to crash, it would be brief, and then the central banks would step in, especially the Fed, and do something to support the treasury bond market. First and foremost, pause their quantitative tightening, if not additional measures, just like the UK has taken. Okay, and finally, just a quick update on gold and the euro and the U.S. dollar. You can certainly trade the euro or the U.S. dollar if you're a forex trader. I monitor it more so to try to get an idea on where gold's going. So I gave you a setup in gold today, but it's what I call a conditional setup. Well, all setups are conditional on the breakout. If it's a setup, there's a difference between an actionable trade idea. So a setup would be that you had this bullish falling wedge, and I believe it was highlighted at the time. That was a trade setup to be triggered with the condition a breakout, especially impulsive, above the bullish falling wedge pattern. So there was so if I would have posted it not in advance of the breakout, but as of right after the breakout, that would be an actionable trade idea. And so I give you a setup here today on gold, but it was conditional on two things: A, gold breaking out first and foremost, most importantly, and then B, also the euro, because in this case the euro broke out but gold didn't. So the euro broke out above that 0.98158 resistance level by a little bit, and it's flagging too, so it may just continue on tonight and pop on through there, and that flag would take us right up to that first target. So that's probably the most likely scenario. So you do have the breakout there, but the other part is you don't have the breakout in gold. Gold, this is a chart I gave you this morning along with that one in the euro, needs to break out. This is the 2-hour, 120-minute chart. I believe that's the one I gave you right there. So you had a divergent low. We're moving up. So far, we have a higher low, but we only have one pivot high there. So if we can take that high out, then you have the early makings of an uptrend. Uptrend simply being higher lows and higher highs. This is a downtrend. Lower highs, 1, 2, 3, and lower lows, 1, 2, 3, or however many you want to count. So we'll watch that. And again, you need to break out. So that's a 120-minute chart. You can zoom down to a 60-minute chart. You'll see the same thing. There's your downtrend line. So no buy signal on gold. Most importantly, especially because gold didn't break out. Gold got rejected at the trend line plus that 1677 resistance right there. But still a nice setup. You've got the positive, aka bullish divergence there. You have a little bit of price support here. And so if the euro breaks out of that flag, I'd have a high degree of confidence that gold's going to go on to break out too and run. And I already gave you those targets earlier today. So that's what I'm watching this week. And nice thing about gold and the euro is they don't have earnings to report, so you don't have to wait around for that. Or they're not as prone to whipsaws as the stock market, because it can take just one big market moving company to come out with something very bullish or something taken as quite bearish for the markets, and that can either add to a rally or squash a rally. All right, that's it. And then, bottom line, euro. What I just gave you was the 60-minute chart on euro, but bigger picture, just like treasury bonds, and it's no coincidence either, you have a comparable downtrend line right here on the daily chart of the euro-US dollar pair, that forex pair. There's a nice clean, I say nice and clean because there are numerous reactions along the way, distinct reactions without any penetration or whipsaws through that trend line. So that would be obviously bullish, more so than anything I just showed you on the 60-minute chart to get a solid daily close above this level, or a very impulsive intraday breakout. If I don't have it, I'll set an alert just to be sure. And then bigger picture, there's still a lot more work on the weekly chart for the euro to do to really firm up the case for a much larger rally, and namely get back above this major former support zone. Now support once broken becomes resistance. So, but everything starts with every journey starts with the first step, and so the first step in this journey would be to take out that downtrend line, and then you have a secondary downtrend line there. You'd probably come in something like that, and then ultimately go on to take it out, and there's a much longer term downtrend line. So that's like the long term picture. Potential scenario, no buy signals on the weekly or daily time frame yet, just that little breakout today on the 60-minute chart. But then you watch that. If it goes out, goes up, that bull flag plays out on the 60-minute chart, you hit the next resistance level, then do you take that out, and ultimately maybe you take out a little seemingly innocuous breakout on the 60-minute chart, turns out to be a breakout on the daily chart, the more significant daily chart, and then that leads to an even bigger run up. So as of now, just like everything else, this thing is in a bear, the euro is still in a bear market, just a couple days off its bear market low, so nothing to get excited about. But again, nothing goes down forever, and there's always a reversion back to the mean, especially with currencies. This is not like it's not like the U.S. dollar against the Mexican peso. This is one of the established it's the biggest component of the dollar index. That's why I focus on the euro. It's a 62 or something percent weighting. And so by far, the euro has the biggest impact on the U.S. dollar index, and that's why we're watching it here. All right, let me wrap it up. That's it. I already gave you the update on lumber. You got a chart out on that, so no need to update that one anymore. I'm just looking at my other charts, see if there's anything I missed. No, that's it. Let's wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great day.